Hello traders, as we continue enlightening you on fundamental factors that cause currency movement, often termed as currency fluctuations, we take a look on how employment data affects currency pairs and the forex market in general. Through this video, you should get adequate knowledge on how to use employment data to trade the forex markets professionally and profitably. Kindly remember to like and subscribe. Employment data such as the non-farm payrolls (NFP) and unemployment rate is a critical economic indicator that significantly affects the price of a currency or price of currencies such as the US dollar, the euro, Japanese yen, and Canadian dollar, amongst others that are traded in the forex market. Generally, there are a number of areas to look at when investigating how the employment data impacts the value of currencies, which we will be taking you through while trying to use the US dollar as the forecast currency. Some of the areas that we are looking at are listed on the chart. As you can see, they include interest rates and monetary policy, global economic flows, and risk on versus risk of sentiment, among others. So let's look at interest rates and monetary policy. It's worth noting that the Federal Reserve, which is the central bank of the United States, closely monitors employment data since it is a key factor in its monetary policy decisions. When the employment data, particularly the NFP, shows strong job creation and a low unemployment rate, it is often seen as a sign of a healthy and robust economy, which would have an impact on the United States dollar. Typically, positive employment data can influence the Federal Reserve's decision on interest rates. A strong job growth and low unemployment may cause the Fed to consider raising interest rates to prevent the economy from overheating and also to combat potential inflation. Higher interest rates usually make the US dollar more attractive to investors as they seek better returns. As a result, the US dollar tends to strengthen following strong employment data releases. What this means is that a trader should be monitoring data releases on employment so that in case the data supports the US dollar, then they can buy the dollar. Conversely, if the data doesn't support the US dollar, then they can short the dollar against other currencies. The next item we'll be looking at is the impact of employment data on the economy, or rather on the strength of the economy. You see that employment data provides insight into the overall health and strength of the US economy. A stronger labor market indicates consumer confidence, increased consumer spending, and potential economic growth. As such, a healthy economy is attractive to foreign investors. This could lead to increased demand for the United States dollar. As the economy grows, it often leads to stronger consumption, more investment, and higher demand for the US assets, which further work to strengthen the dollar against other currencies. As we have mentioned, when the dollar becomes strong, then it is the right time for you to be buying the dollar and selling other currencies. Typically, as we have seen in other videos, is whenever you are buying the dollar, for example, you are also selling the euro if you are trading the euro USD currency pair. Another impact is on market expectations, and you see that generally forex markets are usually forward-looking and traders closely watch employment data releases. Market reactions to employment data can be substantial, especially when the data significantly deviates from the expectations. It is worth noting that positive employment data, particularly when it exceeds expectations, could lead to immediate and sharp appreciation or rise in the price of a currency such as the United States dollar. At the same time, weaker than expected data could lead to currency depreciation since traders would revise their views on the economic outlook. Then there is impact on global economic flows. We see this that strong employment data can attract international investors to allocate capital to the United States, for example, which could result in increased demand for the United States dollar. When foreign investors perceive the US as an attractive destination due to a strong job market, they may invest in the US assets such as the stocks, bonds, or the real estate. This creates an influx in foreign capital, which makes the United States dollar stronger than other currencies. During such moments, traders can take advantage as they see the dollar strengthening to sell other currencies that are paired against the US dollar. Another impact that usually happens is on general market sentiment, that is the risk on versus the risk off sentiment. Usually what happens is strong employment data commands significant influence on market sentiment. That is what we mean in this case is that the willingness to buy or to be bearish on the general market, or the bias that traders develop towards the market following release of economic data, particularly the employment data. So a healthy job market often leads to risk-on sentiment, where investors are willing to take on more risk and seek higher returns. Basically, in this case, you will see traders being more long the market, or rather, they are willing to buy the market. In risk-on environments, investors may favor higher yielding assets denominated in the US dollar, which leads to appreciation of its price. At the same time, or on the other hand, risk of sentiment, which is likely to be driven by negative employment data or other factors, can weaken the US dollar as investors seek safer assets. Another aspect that you'll be looking at as we end towards concluding this video is the impact of employment data on consumer spending and consumer confidence. It is worth noting that employment data impacts consumer sentiment and spending in a significant manner. When more people are employed and earning, consumer spending tends to increase, which stimulates economic growth. Strong employment data can boost consumer confidence and spending, thereby supporting the US economy, which would reinforce the strength of the US dollar, making it powerful against other currencies. Typically, what we mean is that traders should take keen or should have a keen observation on the employment data and the impact that such releases are likely to have on United States dollar. Since if you are in the market and are informed on this, then you're likely to take advantage. So that when the data supports the US dollar, then you know you should be buying the US dollar to rise or make more profits. The bottom line is employment data is a fundamental driver of currency movement, particularly for the US dollar among other currencies, and more so if the data is released on or affecting the United States. Positive employment data can influence the Federal Reserve's monetary policy decisions, attract foreign investment, stimulate economic growth, and impact the market sentiment. As a result, strong employment data often tends to a stronger United States dollar against other currencies in the forex market. Traders should therefore keep a keen observation on the economic calendar to understand which economic data releases on employment data are scheduled so that they can trade with knowledge and avoid getting surprised with losses, particularly if the data is against the United States dollar and they were long the United States dollar. Thank you for watching. Kindly remember to like and subscribe before you go. Let us meet in our next video.